Welcome to Money Hangout once again. Every week we talk about something which is top of your mind, or some suggestion or advice, and try and take as many of your mutual fund questions. This is brought to you by Birla Sun Life and Value Research. Today we are going to talk about something which one of our regular readers, regular visitors of our website, Rajan Agrawal, summarized it so nicely that I thought of sharing these ideas with you in little more in greater detail, simply because we keep talking about all the things that you should be doing, but he very nicely summarized all the things that we should not do. So these are, today we are going to talk about 5 crucial money mistakes, investment mistakes, that everybody should of your financial life, which is very common, and which is worth avoiding, and explaining them, why you should do that. They are also sometimes the mistakes are the general beliefs. Everybody thinks that that is something which is very normal to do. Most people do it, and why it should not be done. What is wrong with it? We all know about the big mistake. Thinking of the blunders or the mistake which we can only say with hindsight of 20 years, 30 years, 40 years. I'm just reminded of the third partner of Apple. We all know about the two Steves, Steve Jobs and Steve Wozniak. They created or built a great company. They created great products, a great company, and they're a beneficiary of that. They became wealthy. There was a third partner, Ron Wen, and he was not a believer, or whatever it be. He sold off his stake in 1976, and he sold it for a sum total of $850. If you would have held all this till now, that will be worth $35 billion, an eye-popping $35 billion. That would have been the worth of the stake of the third partner of Apple. So now we get it that there are mistakes which after a decade or two we can realize, but that is only the hindsight. I'm just going to talk about some of the things which all of you should take note of, should not be done, and the rationale for it. It's not easy not to do them, because they are sometimes the general beliefs. The first one is that our deep belief in the safest investment, which is investing in fixed income, investing in low yielding long term fixed income investment. And there is a reason, this is something which happens all the time. Most investors, their money get invested in EPF, which is mandatory. Then everybody tells you that make that FD, make that, do that fixed deposit, or open your PPF account. These are long term, low yielding fixed income returns. They are not going to make you wealthy. But our deep rooted belief that these are the way to go, and there is a reason for that. There is a reason why we believe this way, why we believe in them, and why earlier generation generation of people used to believe in them. First and foremost, we did not, market was not accessible to them. Today, the way you can buy mutual funds, the way you can open an NPS account and half of your money gets invested in equity, it was not possible 20 years ago, 25 years ago. The only way to invest, save your money and grow it was PPF or fixed deposits. So that was the only. So accessibility was one thing. The other thing is that that is how we are configured. That is how we actually get initiated to investments. Our parents tell us that open your PPF account, do your FD, and we do it. That is fine. It protects the capital, grows your money nominally, but it is not good enough to beat inflation. The primary reason why we do it is that this is how the whole country was configured. Government, we were used to this PPF designed as a long-term saving, discretionary retirement savings plan, yields fixed income. The employee provident fund yields fixed income. So somebody who is 20-year-old, 22-year-old gets into the workforce, gets into the organized workforce, and he starts, the money is deducted. The longest term investment savings that he's doing gets deducted from his salary and gets invested in something which gets you fixed income, because that the most of the money is dominantly invested in bonds. And of course it's structured differently, but the investors get an experience. Of course, people get impressed with the compounding at lower rate, or also over a period of time, leaves an impact on your mind that okay, your money is growing well, nicely. But that is not true. Think of what has happened to your EPF account or PPF account with 8.5%. Assuming this was growing at 16%, what will be the net effect of all that effort? Money compounding at a faster rate, and more so for your long-term money. I think this is one mistake which most investors should take note of. You should not have fixed income investment beyond the essential emergency fund in your initial stages of life, because long-term investment in something which is inflation linked, grows over time, that requires time, and that is the stage of your life when your money should be dominantly invested in equity, beyond the essential money which you can lay your hands on anytime. Another common mistake which most investors should be very clear of, and it is very difficult to do that, which is combining insurance and investment. We all get started with some insurance plan, and that typically is is a very small component of your money is buying insurance, and a good part of your money actually gets invested, and you get the worst of both. Splitting these two things, and why you are being curious, asking the very basic question that do you need insurance, and if you need insurance, how much insurance do you need, and which is the best way of getting that protection. And that will vary for person to person. The moment you have the time when you have no dependents, no financial dependence, you don't need insurance. And the moment you have any financial dependent, you need a large insurance, and that is achieved with a term insurance. So be focused on the utility of all this, and when it comes to investment, evaluate the appropriate investment, make regular investments. And the other criteria which actually should be looked at is your money portable? Can you take your money out, or can you move your money if your investment is not performing well? That is something which is not possible when you mix insurance and investment, and you end up buying the worst of both. So this is a important mistake, and which every investor should avoid. And the other why it is very hard to avoid this, because you come across a friendly neighborhood insurance agent who tells you the benefits without explaining you the alternatives, and it becomes very hard to escape that. And most people get carried by these investments, insurance linked investments, primarily because nobody evaluates them objectively. So ask the very basic question: the risk, return, and the liquidity, and the tax efficiency or the tax benefit that you will get. That is one part of it. And if you are buying insurance, what is the protection that you get, and do you really need it? Is it good enough? Is it the best way to achieve that? Then the what I was talking about, the Steve Wozniak and Steve Jobs and Ron, which is getting carried by the downturn, getting the long term, losing a long term focus when you hear the short term noise. You remember 5 years back, everybody was saying that our country is going nowhere. The economy was in a downturn. It looked like a hopelessness, and from there our market is up despite the absence of economic growth. Our markets are up nearly 55% from those levels, which in itself was at a decent level. So I would say that most investors lose perspective when you are bogged by bad news and noise in the marketplace. And market is a very noisy place. On a day-to-day basis, it could be very noisy. There's a famous quote which I really like, which Bill Gates said that in his book, that most people overestimate what you can do in 1 year, and grossly underestimate what they can do in 10 years. So most people overestimate what they can do in 1 year. Is a classic problem which causes anxiety, because we expect that after we have made the investment, my investment must do well. and we lose sight of what these investments will produce over the next 10 years, and we act irrationally, we act in haste, we act, and many a times we panic. And I have done it many years ago, getting out of at the wrong time, and trying to time it and losing perspective that what I am investing for, what is my time frame. So not losing sight of what you can do, what this money will do for you in the 10 years, and that's an important thing. Avoiding the noise in the short run, and booking profits on good investments to put into underperformer. We all think irrationally when it comes to investments. We think that something which has done well, we must realize the gains, otherwise these gains will sometime vaporize or they will disappear. And we bet on our losers, we bet on the underperformers, because we think we psychologically are unable to reconcile that some of the investment decisions that we made is not working. That's a wrong thing to do. Having a methodical approach to riding your winners, weeding out your losers, and rebalancing is the way to go about it. Rebalancing across investments, across asset classes, is the only way to approach it methodically. It's an important thing to do, but there must be a method to it, and rebalancing actually helps you do that. And I think one of the biggest thing which will actually translate into great disappointment for many people is lack of discipline of dipping into your retirement savings. Today the avenues of spending have just opened up. Today we have a lot of things on which we can spend money, and because retirement is many years away, we don't take it seriously, and we lose the sight of that, and we miss out on the whole compounding magic of compounding. So, and the efficiency with which, the ease with which we can take our money out is only adding to it. Most of our investments are liquid, they're transparent, they're accessible. So if you are not disciplined enough, if you are unable to resist your temptation to take your money out on the smallest of need, you are in for great disappointment. Retirement is going to be a very difficult for two reasons. One is the inflation. The other is most people will have to provide for their own retirement, because we are not working for the government. We are not, even the government employees are no longer going to get inflation adjusted pension at the cost of the taxpayers. So most people have to provide for their retirement themselves, and then we are going to live longer. These are two things which you should keep in mind. If the longevity has gone up from 70 years to 90 years for working class Indians living in cities over the last 10-15 years, this is a wake-up call. If you retired at 60 and passed away at 75, you have to really provide for 15 years. Now if you are going to live till 90, you have to really provide for 30 years. That is a big problem. That is a wake-up call. You have to really worry about it, and you have to really over provide for your retirement than working on the borderline that you are barely providing for it, and this could turn out to be a disaster. So 5 things which I would like to summarize. Don't bank on low yield fixed income investment for the long term. Never combine insurance with investment. Don't let short-term noise distract you from your long-term short-term noise distract you from your long-term approach to investing and your long-term goals. Booking profit from your winners and betting on your losers is a bad idea. And create a retirement-oriented savings plan, and never dip into that. Keep it as a sacrosanct area of your investment, which you will never take out, because that is going to be a very challenging goal as the kind of age we are getting into.